Good morning, ladies and gentlemen. Well, the risk dial is very much stuck in the middle, around 59, and what is slightly worrying is the fact that we're now trading below both moving averages, and that you can see that the distance between the first moving average and the second moving average keeps on coming in. This is a far cry from the days even a couple of months ago when that distance was increasing and was in the 20s and 30s. So it's slightly worrying because we need a breath trust at some stage to take us back above and reignite the trend up to 4,500 or so. That is at the moment not happening because defensive sectors are outperforming the what should be leaders, the aggressive growth stocks. But I reckon at some stage something's got to give, and we will examine the yield curve and the bond market first, because I reckon next week is going to be a seminal week, a very, very important week, and we could get a very strong trend out of bonds, both European and US, developing next week. I say the next week is going to be pivotal because we have a confluence of several factors. We have the auctions, the threes, the tens, and the 30s on Tuesday, Wednesday, Thursday. And we also have CPI on Thursday. So it is going to be very, very interesting. The auctions are very large. In the twos, tens, as you can see, we have a position which has to change next week. Either we bust through 148 and start really steepening, or we bust through the lowest level that we have seen for a long time, which is 138, 139, and then we really have nothing until 126. Well, if we go this way, how is 126 going to be achieved? It's very simple because the 2-year note is going to move very little. So it's got to be the 10-year, which moves 16 basis points, 14, it's 15 basis points, let's call it. So if the 10-year moves 15 basis points, that is going to be a big move in the futures, and we'll examine that later. But the same thing you'll see is evident in every part of the yield curve. We are at a crux in the yield curve. It's going to go one way or another, and that is going to have very big implications for growth assets and also for other asset values. If we look at other parts of the yield curve, 530s on a weekly chart. I mean, how much longer can we stay in this very tight range between 154 and 139? I think at some stage, possibly at next week, we break it. And, 124 could easily be seen on the upside. But if the break is on the downside, it goes a long way down. So we are in a very uneasy equilibrium at the moment. And I think the range in the movement, both of the yield curve and the outrights, is now going to get larger. If we look at the same chart on a daily basis, you can see that if we were to start breaking up through 140, 107, 108 could be, 123, 124, that kind of level could be reached very, very quickly in 2 or 3 days trading. And this could basically be an ABC retracement into that area, and then we can look to come down again. So the same thing can be seen actually in the 5s, 10s. If we got a retracement to around this area, 60 basis points or so, would that be so dreadful? But that is a 17 basis point move. So whichever chart I look and whichever part of the yield curve I look, you could get some pretty intense moves next week. In terms of the individual tenures, if we enlarge this area in the chart of the 5-year note, you can see that basically the Bollinger Bands are quite close, around 76, 75 basis points. So that's only got 2-3 basis points before it stops. And really, it's very difficult to believe that without some major, that in front of major auctions and major data, they would push the market too far. So Monday, Tuesday, and Wednesday, we are likely to be setting up shorts for the auctions, so to make sure that they go well. So if we stayed in this area and backed up a little bit, that would be no surprise. Do something like this. And what happens on Thursday after CPI is really going to be key. Because let's face it, they have the 30-year auction at 1 o'clock on Thursday, while the CPI comes out Thursday first thing. And they've already bought the threes, they've already bought the tens, they're loaded up. It's a risk. So they will want to get it at a half decent level. If they get it at these levels, and this is now a chart of tens, if they get it at levels which are too close to the bottom of the range, they'll be puking them out here around 170. So I don't think that's in anyone's interest. I think the first couple of days of next week are going to be in the sign of backing up a little bit, just to get the auction away at levels which are not too ridiculous. But if the CPI is a good number in inverted commas and is much less or is slightly less than the market is expecting, a breakdown through 151 in no way can be excluded, and that would target 139. And I think that would happen very quickly, probably on Thursday itself or by Friday. In which case, basically, this becomes some sort of an ABC correction, and we will be trading at 139 by the end of next week. And that actually slightly changes the whole trajectory of the bonds and the yield curve, because people will know it's so expensive to fund such a steep yield curve. We could easily have a situation whereby people now start buying bonds and take the yield curve down quite a bit. I would not be surprised in the slightest to see in the 30s, as you can see here, if this chart would ever work. You know, if we start breaking below this level, which is 221, in the 30 years, there really isn't very much until we get to 2 or just below 2. We have these gaps here, which would not be really surprising. So you're looking for a big potential move in 30s. So it's going to be a very, very interesting week. Do not fight a move through 220 in no way. Closes below 220 give us really a target below 2. And that is a very, very big move. Just like their US counterparts, the European markets, bond markets, are poised for a big move one way or another. This is the bubble, the 5-year in Germany. As you can see, after reaching exactly the target, it's come back and it's now at support. Could that support be broken? Yes, but the bubble is the one that's going to go the least. So just like in the US, the curve will be flattening if it's in the downward yield direction. And really, I don't expect it to go much through here, which is what, 64, 65. So that is, that is a 5 basis point move down. While if we have a look at the Bund, you can see that we are at support just like in the bubble, but if it starts moving, I don't think this 25 level will hold it. I think it might go all the way down to here, around 33 to 38. So that would be a big move down in the in the 10-year note. Although, and conversely, if CPI is very bad, you can see that we can go back up to and test the minus oh 05, minus oh 06 area very, very quickly. So that is why I'm saying, I mean, I have no idea what CPI is going to be. So that's why I'm saying the markets, both from a supply standpoint and from a technical price standpoint, are very much at a crossroads. They will move violently one way or another. And the more I look at the other markets like the 10-year this is the differential between the 10-year in Germany and the 10-year in Italy. Where are we? We're right at support. So basically we are either going to go straight up to 120 or start breaking down and going back down to these lows around 92. Everything is, this is actually the chart of the outright Italian bond. And you can see how basically we are either going to go all the way down probably toward this 55, 56 level, or we're going to go all the way back up towards 120. There's really no two ways about it. And France is even more obvious. Here we are, in 2 or 3 trading days, we could be busting all the way down to around the 0 mark. And that is a 15 basis point move. That is a big move. And this could be an ABC all the way down to 0 or negative, slightly negative. So every single bond market that I look at is saying we are very much at a level and we will be far away from it by the end of next week, depending what CPI is. And not forgetting that the yield curves are going to adjust a lot. So if it's a decent CPI, you want to be buying the long end, and if it's a very bad CPI, you want to be selling the long end. The moves are going to be very much in the long end. I don't think the 2s and 5s are going to move very much at all. Finally, I want to show you a chart of the 10-year against the Bund. As I've been saying, it's been pretty much stuck around this 175 basis points. But I don't think this is where it's going to end up next week. Either it's going to bust straight down through, in which case we're going to these levels, first of all, so around 165, or if the data is very bad, we could easily be going up to 186 basis points. So it really is going to be a pivotal week, both in the in everything, in the differential between Europe and the US, which is going to have an influence on the dollar, and the yield curves will be very different by the end of next week. I'm pretty convinced. So Thursday, the appointment with CPI, very, very important. From a macro standpoint, the dollar is something to be avoided until at least Thursday. What to say, the market keeps on basically trading the same range. If I try to enlarge this weekly chart, we traded this week more or less exactly where we traded last week. All that happened is that some people got overexcited and stopped out, and the market came right back. This to me is not a bullish sign. I mean, I am pretty convinced that the dollar should go lower at some stage, and really a decent CPI number, i.e. not a high one, should help the dollar go down and head towards the first support at 88.44. I am a pretty convinced seller up here around 91.01. But I'm willing to be proven wrong, and we will see what happens. I just can't see from a fundamental point of view what interest the US would have in having a strong dollar. Everything that I look at points to a weaker dollar, and therefore I just can't make a macro case for a stronger dollar, but I'm willing to be proven wrong. I still think it's very much an avoid until we see data, and I think data is what's going to push the dollar out of this range that it has been in for, well, since the beginning of the year. If you're looking at important levels apart from 91.01 in DXY, you can see how important this level just below 120 is, 119.89. That is where the 200-day moving average comes in. That is where everything is, centered. You can see these very important lows. If it breaks through there, I think, but I mean, there's no chance in the early part of next week. If we close below there next week, then of course, I will have to say I'm wrong. The dollar's not going down. But I think the likelihood of that happening is very, very low. But I have a very important level, and I know how to set a stop, and that's all there is to it. If my macro view is wrong and we don't go up towards 123, 124, 125, I'll know to get out. I don't think gold is going to be a prime mover next week, simply because whatever happens, it's going to be buffeted between the dollar and bonds. If CPI is very strong, bond yields are going to go up, and that's going to depress gold. And conversely, I don't think if CPI is good, that is psychologically not good for gold, so it just meander. But it should get supported. It should get support from the fact that the bond yields are going down, and probably that the dollar is going down. So I think gold is probably taking a rest for a couple of weeks. It's not. It's really not going to be the one that's going to show the way, I don't think. But technically, it's getting. It's beginning to look better and better and better. It's closing the week easily above 1881. It's beginning to slowly stop this 200-day moving average from going too far down, and therefore its slope might change. It's quite close to the top of the weekly Bollingers, so a move down really would not surprise. But I think if we see this 1780 level, it's going to be a wonderful buy. I think it's going to be very difficult to see that. But really anything around 1820 is going to be, to me, the floor for gold for quite some time now. I don't think it's likely that we go lower than that, simply because I can't see, even if we have, 1 or 2 weeks of 1 or 2 months of better or not worse CPI numbers than the market fears. I don't think that the fear of longer term inflation is going to completely disappear, and therefore I think gold is going to be supported around these levels. This is a spread between TLT, i.e. bonds, and gold. As you can see, it's taking a bit of a rest. This is a weekly chart. So it really isn't, while it's still very much in favor of gold, it would really be no huge surprise to see it rally back up to this kind of level. And if that were to happen, that would indicate that bonds are doing better than gold. There's only so far that bonds can go, and therefore, it gives you an idea that gold really is not the prime mover for the next couple of weeks, I don't think. I think it's an avoid trading asset as well, unless it gets to an extreme that is very much interesting longer term. So this chart basically tells me that it wouldn't be no big surprise if gold didn't do very much for 2 3 weeks. But naturally, you could always get the converse and we bust straight through there, in which case we are looking for these levels first of all. And I'll put an alert for myself if we see it down here. Um, and then we have the all-time lows after that, in terms of relationship. I mean, not all time, but for the past 20 years since these ETFs have existed. So it really, it's not a surprise to see it go sideways for a bit. Gold against copper also finished the week, and it's amazing how the market comes back to very important levels right before a crucial number release. I think this 158 level here that you can see is very, very important. I think by the end of next week we will be, either down here or possibly up there. So, it just tells me that we are at a crucial week for bond yields, and bond yields are going to have their effect on gold and on copper and on everything, like especially commodities. Last week, this was not my favorite direction of travel. DBC actually bust through these levels. So now we have two alternatives. Either this is a false break and it comes back next week, there is a possibility, or basically just continues. And in 10 20 weeks time, it's here at 24.39. It's basically quite Manichaean. It's going to be one way or the other. There is not much choice. So that also implies that next week is very, very important. If CPI keeps on trucking much stronger and much higher, I think the direction of travel of DBC is going to continue to be violent to the upside, heading towards 24.39. Equities had a very interesting week. Interesting because they were so predictable. Basically, this 4180 level has proven its importance on a closing basis. We never for a single time closed below it, and every time we touched it, we went straight back to 42.32. It's just very interesting to watch how the market is really in a very, very tight range. I mean, this is a 50 tick range, which is what? Just over 1%. So, and we've been in that range for, I don't know, well over a week, best part of 2 weeks. So it's very, very difficult to believe that we will stay in this kind of range for very long. And really Thursday, I think, is going to be also very important for equities. Now, this is a weekly chart, and as you can see, 42.32.60 is the all-time closing high. Would it be a big surprise to see it come back early part, just so that people don't get completely buried on their holdings in terms of when CPI hits? But when it does, well, it's going to make it, I think it's going to make it either bust and go all the way up to much higher levels, or it's going to have to try this support at around 41.29 to 41.14, and where it closes the week is going to be absolutely pivotal. I just don't see much alternative. you know, by next by Thursday, this Bollinger Band will be, well above 4260 or even 4270, and I reckon that's probably where the market will be headed if we have a weaker CPI number and the bonds are helpful. I think that really reignites growth, and that's why I think actually NQ is going to be a much better tell next week than anything else. NQ had, and basically unchanged week, but it was quite an interesting development. Basically traded with bonds. This is the QQQ on a weekly basis. You can see, nothing. But it keeps on holding the moving averages. It keeps on holding the moving averages. And as long as it does that, the likelihood is that it goes to the top of the Bollinger Bands, and that is just above the highs, and that is just, busting 14,000 and probably trading 14,100, 14,200. To me, this 13,717 level is important. We closed above it, so I have to give it the benefit of the doubt. Would coming back towards 13,600 next week really surprise me ahead of the auctions? No, not really. But it's where we close Thursday that I think is going to be very, very important. We still have this gap all the way up to the highs of, this is where we closed 14,050, and there's this gap. If the CPI is good, that gap gets closed, that's for sure. For a long time I've been saying that no index can go down very far until they are all ready to go down. And, the transports are beginning to change the way they are configured. I think now 14,750 level in the transports is going to be very, very important, because even if this is some sort of an ABC corrective, it should not really close below that level. So transports are beginning to change their outlook. Dow Jones is still looking bullish. The industrials is still looking bullish there, but it's losing momentum. Everything is losing momentum. But what will be very interesting to see is actually if growth, i.e. Nasdaq type stocks, can regain some kind of a leadership and continue to levitate the indices. And that's only going to happen if bond yields go down next week. So we have that conjunction. Bond yields down, Nasdaq drags everything, and probably transports and Dow do not very much. Dow because it's quite heavy in financials. And that's actually going, the financial part of it, if bond yields are going down, is actually going to drag the down. So really the Dow is going to start looking much more like the transports. And then, much further down in time, you can get a rotation where all indices go down. But I don't think that's going to happen for quite some time, so there's no point in worrying about it. What will be interesting is to look where the tech spreads are going to go next week. These are the tech spreads, and what will be especially interesting on Thursday is going to be XLF against XLK. If we enlarge this area, you can see that basically we have been trading. This has been a very pivotal level, the 0.27, and I bet you that on Thursday we're right on top of 0.27, ready to make a breakdown towards this kind of level, 0.24. So that's a big move. Okay, that's almost a 10%er, and then hopefully this moving average, which has been turned, is ready to take us back up. So that is, and that is going to be reflective of what happens, absolutely reflective of what happens in bonds on Thursday. So you can see how pivotal everything is, because the only the only way I think the the market can do substantially better is if tech resumes leadership and financials and others don't really lose it too much. I don't think a 20-point move in the bonds is disastrous for financials. It's going to set them back, but it's not going to kill them. On the other hand, that it could significantly improve Nasdaq and take it to new all-time highs, which is going to keep SPX levitating and going up with it. Even though Dow is probably going to be the worst performer in that case, but it's not going to go down very much because even industrials should like the lower bond yields a little bit. So because these bond yields will not be caused by the lower bond yields will not be caused by a recession. They'll be just caused by less need to tighten rapidly by the Fed, i.e. QE keeps on going. And therefore, really, it's a net positive for the market. But the market that's going to have the biggest bang for its buck is definitely going to be the high growth tech names, which could easily come down to these kind of levels. Was that 25? And that is, that's a 10% move. A setback in that spread between XLF and XLK, it actually shouldn't surprise anyone. This is a chart of JP Morgan. You can see how extended it is. I mean, this has to be a fifth wave kind of thing. So it could easily come back down to these kind of levels. What's that? 160, 151, 152, 153, without doing any harm to this chart whatsoever. And on the other hand, it's quite interesting how a chart like Apple, which is sitting on the 200-day moving average, could easily have a move back up towards, closing these gaps around the 136, 135, 136. Basically Apple has done nothing, all the way since August of last year. And therefore, it really wouldn't be surprising if it did go up. I mean, sitting on the 200-day moving average, as I said, is just not what the market likes to do. It's not normal. Here we have Microsoft. Could we be turning up? Absolutely, we could be turning up. And, would it be surprising if we go and fill this gap up to, 200, what is that, 260-ish, 260? No, it still would have done nothing. So that is why I keep on saying that the tech is going to be important and interesting next week. The thing that worries me is this Amazon chart, which just will not get going off the 200-day moving average. That's the only thing that is really stopping me from going very much overweight in, significantly overweight in tech and the Qs and things like that. But, I'm going to wait for Thursday and then pile into tech if the, relative to other sectors, if the bond market gives me the signal. Another reason why I think that next week for the stocks is going to be a relative move, i.e. which goes up most, is the fact that Europe just keeps on trucking. I've been overweight Europe for quite some time. I've given you all the reasons, and I think it just keeps on going. I mean, the DAX keeps on closing at the highs, and every time we try to test a little lower, the wall of money coming in to buy it is quite impressive. I'm very, very happy with both the performance of stocks and the performance of DAX. If we change that to the monthly stocks, you can see that we're very close to this to this monthly uptrend that's been holding very well, this fork. So we could be coming towards the end, yes, but there is absolutely no signal, no sign that we are topping out. We need some kind of a reversal signal at least to stop being bullish of Europe. And when we stop being bullish of Europe, and we stop being bullish of Japan, and we stop being bullish of EEM, and this is now the Nikkei, it's really not doing anything wrong. It's, to me, it's more likely to test the 30,200 level again than it is to break down. It's corrected sideways in a lovely ABC pattern for a long time, and it could actually start breaking higher. And I think if it starts breaking higher, it's going to take EM to the, which finally closed above 55.83. It's going to take it back up to the highs. Don't forget that here we have a gap to around 57.60, and I think that gap over the course of the next couple of weeks gets filled. And if we don't stop, it's a new wave higher. Don't forget that basically by doing this, we have consolidated a break above these all-time highs that, they've been going on since 2010. So we have a break of an 11-year consolidation, which should take us really about this kind of distance on top of here. So if this is between, call it 25 and 50, so that's 25 points on top of 52, it should take us easily into the mid-70s. So this is potentially a big move, and I hate to get out of it because I think the potential to the upside is so great. If we look at the EEM spreads, you can see that this moving average between EM and EWG, which is Germany, and Europe, is slowly going up and, flattish here. But we've made finally, we made what could possibly be a significant higher high in EM. I know. I've been looking for it for years, but it could finally be a higher high of medium-term importance. In which case, we are going to go up here. To me, that suggests a strong move up in EM, which has to be bearish for the US dollar, because it would just mean that money is leaving the US and going into EM. Another argument to prefer EM longer term and to be bearish the dollar, I think. But those are very much big picture macro arguments, and we will go here week by week. Finally, VIX is not giving any warning signs. It spent all week trading in a tight range. It never closed above 18.5, and it closed the week basically at the lows 16.5, which to me indicates that we try this 15.58 at some stage and possibly go down. You can see how on a weekly basis the real support is around the 12.20 area. If I enlarge that, you will see that it's right, 12.25 is the level that eventually makes down to. Makes no mistake, there are still all these gaps here, all the way up to here, actually, to 27.50. They will be filled at some stage, but you can see how long it takes. It normally takes 3-4 weeks before the market has a correction, and we're only been two. It would not surprise me to get another couple of weeks down, and then a correction. That's why next week I think is going to be a question of playing tech on Thursday. I'm getting the feeling that the bond market is going to be significantly different on Thursday, and my water tells me that it's going to be a rally in futures and a drop in yields that's going to catch everyone unawares. That's just going to fuel NQ. And we're going to see a new high in NQ, a new high in SPX, and not a new high in Dow Jones, and not a new high in transports. and that will stop everyone out because everyone's positioned on this reopening trade. And then slowly we reverse that, but one thing at a time. And onto the cheat sheet. All the levels are marked. 2s10s are going to be very important next week. 5s30s are also going to be important. And I've also inserted the levels, the yield levels in the 10-year note and the 30-year note because they're going to be very, very important. I think below 151.5 and 221, you're going to have a significant flattening of the yield curve after, if those levels are breached. Otherwise, because the market is going to be so heavy with supply that you're going to go to one of these extremes without doubt. And if we start going through these, I think, I've shown you how far we can go. Anyway, all the levels are here in BTPs, Bunds, the spread between BTP Bund. I think I'm going to be watching the spread between BTP Bund simply because the BTP tends to move far more than the Bund, and therefore if that spread starts breaking 106, that will be another leading indicator that the move in all bond yields everywhere is on the downside, and that's going to give me my signal for tech stock outperformance. All here, and it's still important to watch Apple and Amazon carefully because their performance is really not normal. They need to get moving for me to be right. Thank you very much indeed, and tweet you on Monday.